you for joining us. I'm Juan, lead trader and founder of ProsperiTrade. In this video, we're going to discuss due diligence and some basic steps so you can start taking your own due diligence. Before we begin, please review our disclaimer. Here at ProsperiTrade, we are not registered as investment advisors. Please do your own due diligence. So what is due diligence? Due diligence basically is an investigation, review, or audit performed to confirm facts or details if a matter under consideration. So basically, in a stock that you believe in, you found the stock, you're going to check the financials, check the management, past company performance, products, future products, risk, competition, anything that has to do with the company, any potential risk, litigations, lawsuits, just taking a deep dive on the company. So where to begin? The best place to begin, and where I always start, is on the company's website. On the website, they're going to have an investors relations section, and there you can find presentations, conference calls, earning calls, interviews. I always listen to any of their conference calls. Some of them are 40 minutes, 30 minutes. Some of them go over an hour. But they give a lot of information, and you hear from the management some of their future endeavors. If they had bad earnings, they explain why they had bad earnings and how they're going to recover, plans of actions. And it gives you a sense of where the company's going, their vision, and it'll help definitely with the foundation of your due diligence. And this is where I always start. So the next thing I do after that, I start checking the market cap. Are they a mega cap, large cap, micro cap? If they're a micro cap, then that's going to possibly skew my decision. I don't want to choose a company that they have a low float and there's going to be too much inconsistency and spikes, and just I want a stock that's going to gradually increase over time. And the micro caps or the penny stocks, they're too volatile. Then you want to check the SEC filings, quarterly, annual reports. I usually get last year's annual report and start reading as much as I can from beginning to end. I'll look at minutes, if there's minutes, their structure, their bylaws. With the company, I like to keep it simple. Just one of Warren Buffett's major rules is the business simple and understandable. Is it a product that you understand, that you can stand behind, that you believe in? If so, then move on to I start looking at their revenue, profits, and margin trends. And you can find all that in a lot of websites. Alpha, you can find it in the investors relation site, in their own website. They usually have their annual report, or you can just go on and look up SEC filings and find their annual report. In their annual report, you want to check their income statements, their net income, and you want to do this over the last few years. I like to go back as much as 5 years if it's an older company, and monitor the trends. Make sure that the revenue, the operating expenses, the profit margins, and all the return of equity, that they're trending upwards, and that there's not less revenue coming in over the next few years, more operating expenses. So you just want to monitor these trends. Then you want to compare those trends. And this is whatever information you gather, whether it's ratios, whether it's revenue, income, you want to compare it with companies in the same industry. So if there's 2 years that every company, for some reason, their revenue went down, whether it's something that has to do with the macro of the economics, then you take that in consideration. So after comparing those trends, you want to analyze the price to sales ratio, analyze the price to earnings ratio, note whether the growth is consistent. You don't want to see a major spike 1 year and then no gradual growth over the next few years. So you want to look at all those type of trends. In the financial statement, you want to look at the income statement, the balance sheet, cash flow, all their footnotes, their long-term debt, short-term debt, their debt to equity ratio, and you want to compare that with the competitors. So again, this is just kind of like a brief overview on how I start my due diligence. We will have future videos, future education guides on how to read income statements, how to read balance sheets, and how to take a deep dive and fully understand what you're looking at. But this is just a brief overview. Then you want to also look at planned versus actual results. And I noted EXAS, it's a stock that we discussed. So EXAS recently, just today actually, listed their earnings, and it took a drop. It actually went down quite a bit, and the earnings were positive. But a lot of people took into consideration that there was a quarter billion actually, of unexpected earnings due to COVID testing. So it's unexpected earnings. If those earnings weren't there, their earnings would have not looked as good. And next year they possibly won't. They can't count on those earnings. So it's unexpected earnings versus planned. So that's something you want to take a look at also. You want to look at financial projection, capital structure. You want to look at their assets and operation, current budget, cost of sales, intellectual property. Then that'll be like the trademarks, the patent, copyright. You like to look at those things because if they have trademarks, if they have patents, if they have things that other competitors can't imitate or can't do as easily, then you're starting to talk about companies that possibly have a moat in the market. You want to look at the value multiples, like the price to earning growth ratio, the PEG. For company and competition, look for discrepancies. PE ratios can form initial basis for evaluation based on trailing or current earnings. It'll help you determine if your company is a growth stock versus a value stock. And this is also important, like if you're choosing a company that is well established, like the Apples and Microsoft, you definitely want to have those in your portfolios. So if you're building a portfolio, and this is kind of a side note, if you're looking for long-term growth, like something you want to put together for your kids or for yourself in the next 20 years, you want to have a good balance. You don't want to have more than 5% in any company. You want to choose a good amount of stocks. You don't want to have probably 20% exposure to any industry. So something like that. The stocks that I talk about are more like disruptive technology. They're riskier, high reward. But if you're building a portfolio, you don't want to have too much exposure in any industry. So you also want to use these PE in conjunction with price to book, price to sales, enterprise multiples. And these multiples, they're going to kind of give you an idea of how the valuation of the company is as it relates to its debt and its annual revenues, its balance sheet. And you have to take into consideration that these ranges in value differ from industry to industry. So that's why you want to take these numbers and compare with the competitors or peers in the same industry. And that PEG ratio brings into account the expectations for future earnings growth and how it compares to current earning multiple. The next thing I look at the competitors and industries. So market position and related strengths and weaknesses as perceived in the marketplace. So where they stand in against their competition. The competitive landscape. Do they have an advantage? Potential profit for sector or business. So are they in an industry that's dying? If, for example, if people stop using oil and everybody's going electric, then you want to take that into consideration. You definitely want to look at the macro when making any decision in investing in a company long term. So do they have an edge on the competition as far as pricing, maybe services, moat? Do they have a moat against any type of, like, for example, Microsoft? Microsoft, they have Windows. Windows is everywhere, and even if another company came with a similar product, it's going to be more expensive for those big companies to change out Windows for the new products. So something like that. Do they have an edge technology? What is their edge over the competition? What is it that they're doing differently? And then you want to use all this information and all these ratios and all their financial information and compare it to their competitors. So after that, I'm going to look at the management and ownership. Is the company being run by its founders? That's something that I like to see. I like to see that the original founders, they're invested in the company, they're still running the company, they have stock in the company, they have high interest, they want to see the company grow. That's something that's really important to me. Do you see consistent management and consistent board members, or are they changing out every few years? Experience. Is it an experienced team? Is it a team that has a great resume? They have success in the past. Sometimes a company that hasn't been doing too well, they'll bring in somebody that has past history, that they've grown other companies, and that company will get a kind of like a boost. You'll see a spike in price, and it'll be a positive outlook, and it'll probably bring in more investors if there's new management that has past success. Next, you want to see if there's a lot of institutional ownership. I like to see companies that a lot of institutions are investing in them. And I like to look at the P ratio, and kind of like, the average P ratio for the S&P, for example, historically has ranged 13 to 15. So a company with a current P ratio of 25 is above the S&P average and trades at 25 times earning. So usually these high multiple indicates that investors expect higher growth for the company compared to the overall market. And next thing, I want to find all the risks. Are there lawsuits against or initiated by the company? If it's like kind of like a medical company, do they have a history of missing endpoints? Does it have any bad press, any illegal activity, especially with SEC? Are they eco-friendly? You want to look at the macro and the micro, the industry-wide risks and company-specific risks. Does the business have a favorable long-term prospect? Are they regulated? Do they have a desired edge on the competition? Can they easily be duplicated? Do you find the management to be honest, or have they participated in any type of shady activity like option backdating or anything like that? And again, like, do they have a history of SEC regulatory problems? Then I like to take a dive in the marketing, sales, and distribution. What's the marketing plan? Like, what kind of plan do they have? Where are they marketing? Are they partnering with international entities so that they can grow internationally, or are they just domestic? So what exactly is the marketing team doing to grow the company? Research and development. What are some strategies, key personnel, some important people that have a past history of success, new product pipeline, status, timing, cost, profit potential? Are they entering into a new market that has a large potential for growth? And another thing I like to look at is the work culture. Sometimes I'll go on the Glassdoor and see what employees, past employees, are saying about the company. What's the work culture? And so work culture is important to me. Then after you do all that, if you want to take a look and see what the intrinsic value is, if the company has enough history where you can kind of produce an intrinsic value. And we're not going to go into this, but these are just some of the steps. You have to estimate company's future cash flow, calculate the present value of each of these future cash flows, sum up the present value to obtain the intrinsic value. So you kind of find, is this company discounted? Are you getting a good value for this company where they're at right now? You don't want to buy a company or invest into a company that's spiked up a whole lot and really is possibly due for a correction. So these are some of the steps that I take for my due diligence. Then you want to factor in also, is this a disruptive company? So a company that has only been around for a few years, or a company that's switched its model and they're starting to enter into a different type of technology. For example, EXAS, for many years, they've been doing Cologuard, and now they're getting into genomics and just changing up their business model. So this is just kind of like a brief overview of how I do my due diligence. This is very basic, just a foundation, and you build on each of these steps and dive deeper. And then sometimes, you do all this, and because of this, you see that their competition is a better company to invest in. So, you know, don't be discouraged. You have to be able to start over and go to the next company and do your due diligence if you find some other competition that's better suited uh, to invest in. It's your money and you don't want to lose it. You want to invest in the best company that you can. So this was just kind of like a brief tutorial of how I do my due diligence. Someone asked me, how do I do my due diligence? I base it off of these things and I dive deeper. And the great thing is, you know, the internet is our best friend. If there's any type of red flags, if there's any lawsuits, anything, you're going to find it. So again, thank you for joining us. Don't forget to hit the like, subscribe, and see you on the